Q1 2026, the Executive Risk Recap. What changed? The year started with a list of concerns: regulatory uncertainty, energy market volatility, ESG accountability pressure, and a grid that wasn't ready for what was being asked of it. 3 months later, some of those concerns materialized exactly as predicted. Others surprised almost everyone. Before your team shifts focus to Q2, it's worth taking an honest look at where the quarter actually landed and where the unresolved risk is still accumulating. What actually moved in Q1? Regulatory pressure came faster than most capital planning teams had accounted for. The early year signals around methane enforcement, air permit scrutiny, and Scope 3 reporting expectations were not hypothetical. They translated into enforcement actions, investor inquiries, and supplier friction within weeks of the calendar turning. Companies that had already begun internal alignment across legal, sustainability, and finance found they had the time to respond thoughtfully. Those that hadn't spent Q1 in reactive mode, which is expensive in ways that don't always show up cleanly in a single quarter's reporting. Energy price volatility also proved more disruptive than many procurement teams had budgeted for. According to the U.S. Energy Information Administration, EIA, natural gas spot prices swung by more than 30% across key markets in the first 10 weeks of the year, driven by weather events, infrastructure constraints, and demand spikes tied to data center expansion. Organizations with flexible contract structures absorbed that pressure. Those locked into fixed-rate arrangements with limited hedging options felt it more acutely. Grid reliability, specifically the growing gap between what the grid is being asked to do and what it can currently deliver, also moved from background concern to operational variable in Q1. Utilities in several regions issued demand response alerts during peak periods, and several large industrial users reported curtailments that affected production schedules. This is not a 2027 problem. It's a 2026 operating condition. What didn't move and why that's its own risk. Some of the conversations that needed to happen in Q1 didn't. ESG governance in particular remained fragmented across many organizations. The expectation from investors, from major buyers, from regulators, that companies would have clearer, more integrated sustainability reporting in place by mid-2026 has not been matched by the internal readiness that requires. Reporting gaps that were visible in January are still visible now. They will be harder to explain in Q3. Supply chain Scope 3 accountability is in the same category. The pressure is real and documented. The internal processes to actually measure, report, and engage suppliers on emissions data are still lagging in most organizations outside the largest enterprise tier. That gap is not a 2027 problem either. Buyers are already conditioning contracts on it. Infrastructure investment decisions also moved slowly in Q1. The capital case for on-site generation, storage, and grid-independent resilience has been clear for some time. But many organizations are still in evaluation mode, and the window for favorable financing terms is narrowing. The war in Iran. The IEA described the situation as the greatest global energy security challenge in history. The conflict began on February 28th and caused immediate volatility. Brent crude surged 10 to 13% to around $80 to $82 per barrel by early March. It has since moved significantly higher. Oil spiked to nearly $120 a barrel about a week after the war began, then settled around $100, compared to roughly $70 before the conflict started. The Strait of Hormuz is the reason the numbers are so severe. The conflict has led to the suspension of about a fifth of global crude oil and natural gas supply, as Iran targets ships in the Strait of Hormuz and attacks energy infrastructure across the region. Qatar declared force majeure on its gas exports after Iranian drone attacks, and it may take at least a month to return to normal production levels, putting upward pressure on long-term bond yields. Does your current energy procurement position reflect the market you're actually in right now, or the one from when your contracts were signed? Analysts project oil prices could rise further to around $130 per barrel in Q2 if the conflict is prolonged. The honest executive conversation. Here's what doesn't get said enough in quarterly reviews. The risks that didn't cause a visible problem in Q1 didn't disappear. They compounded. Regulatory exposure that wasn't addressed is now 3 months closer to enforcement. Energy contracts that weren't renegotiated are now 3 months further into an unfavorable rate environment. Reporting gaps that weren't closed are now 3 months further from the disclosure deadlines that will make them visible to the market. The organizations that will be in the best position heading into Q4 are the ones that don't treat Q2 as a reset. They treat it as the continuation of work that should have started in January. According to a recent report from Goldman Sachs Global Investment Research, corporate boards that integrated climate and energy risk into standard capital planning cycles outperformed peers on total shareholder return by a meaningful margin over 3-year periods. The mechanism isn't complicated. Earlier identification of risk creates earlier optionality for response. 3 questions before Q2 planning locks. Before your Q2 planning cycle closes, 3 questions are worth pressure testing across functions. Do we have a single, current view of our regulatory exposure across environmental, energy, and ESG obligations that finance and legal have both reviewed in the last 30 days? Does our energy procurement position reflect the market conditions we're actually in, or the market conditions that existed when our current contracts were signed? Can we explain, clearly and specifically, what our Scope 3 posture is, and what our largest buyers would learn if they asked for documentation today? If any of those questions produces a long pause, that's the work for Q2. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.